Okay, so we're here with episode 2, session 2 of the weekly update with Global Prime and our in-house head of trading, Greg Rubin, a man that needs no introductions. Had a little bit calling you self-confessed lover boy of the markets. Yay or nay, true or false?
I definitely can't deny that.
Okay, fair enough. We'll get right into it. Okay, so the first thing I had is a quote, actually. So I was watching an interview from a YouTube channel called Institute of Trading, and they were interviewing this trader, and he said this interesting quote, which I think speaks a lot about risk management and the process of a trader. But it said, "Be patient with your winners and impatient with your losers." It's a quote where he was speaking pretty much, I think he was just speaking directly about risk management and that topic. So I guess just what would your opinion be on be patient with your winners and be impatient with your losers? I guess that's something to do with risk management and stop losses.
So yeah, it's a common saying in the market, let your winners ride and cut your losses early. Exactly a different way of saying the same thing. And yes, it's a problem that a lot of traders do struggle with, because psychologically, when you see your trade in profit and perhaps you had a loss or two beforehand, you're very quick to take the profit. Yet when the market moves against you, you tend to hold on to your losses on hope that the market is going to turn around. And it ties in with averaging into losers, which we've spoken about before, which is just something that one should not do. And unfortunately, it's sort of human nature to try and hold on to losses and hope that they come back. You know, how often I hear, well, I'm just going to hold this until it comes back to break even. And you're literally in a trade hoping the market can go higher so that it hits your break even level so you can get out, where it's against your analysis. You can see it's clearly not working out. So you're much better off to, once you acknowledge that the trade's not working out, to cut it as early as possible. And it's the same thing. Let your winners ride towards your target. You know, often you've set a target where you expect the market to go. It hasn't done anything to show that the market's not going to go there, but you see a little scare or a little micro pullback and you start to get scared. You start to trade your profits and not the actual market, and you quickly take your profit. And a day or two later, when the market goes and hits your levels, you go, wow, I should have held on. I knew it was going to go there. So yeah, absolutely agree with it. In practice, it's a lot more difficult. It is something that I work on a lot in my trading mentor room. I think it's very important. And again, if you trade with structure, it becomes a lot easier when you have clear invalidation levels and you have clear target levels. Then that whole let your winners ride is a lot easier when you actually have a strategy and a plan, and you know where you expect the market to go, and you know your levels where it invalidates, so you can take profit or you take a loss early. But yeah, absolutely agree. And just taking that a step further, when it comes to trading, you should certainly only have these trades in your vocabulary. It's scratch trade, small winners, big winners, and small losses. As soon as you eradicate the big losses, you start to see the huge difference it will have on your account.
Very nice. So speaking of markets, we've got gold hanging around the 1800 mark and silver sitting around 23, 20. Did it get to 26 or not quite yet?
I mean, earlier this year, yes.
Okay, fair enough.
It got close actually recently.
Yeah, nice.
Got up towards 25-ish.
So my question is, with people speaking about inflation, is it possible that gold could hit this might be very futuristic, but a 10K mark, and a silver could hit a $200 mark? Is that feasible in the future?
I think it's very realistic targets, if I'm honest with you. I don't think inflation is going to be the driver. We spoke about metals and inflation hedge recently. Gold, silver, many things, many positive things, but when it comes to being hedged against inflation, I think that's a myth. So yes, my primary expectation is for gold and silver to see silly levels. Unfortunately, for the impatient, I think it'll be a little time away. Looking at the charts at the moment, I'm looking for one more push higher in these current legs up to also the move that starts with the corona lows, and gold in 2000 for silver and gold in 2015 towards the 2,300, 2,500 level. And I am anticipating a strong pullback from that region, all the way even towards the 2016 lows, before we start to see the real move, which I do think can hit silly levels, 4, 5, 6, 7, 10,000. You can name your number. But I still think that's some years away, and I think the big buying opportunity will come after the next high, and the pullback that follows will be a big buying opportunity, in my opinion.
Very nice. Yeah, we just had a little rally in the last month with gold, I saw on the charts. So to a technical analysis question, we know you're a technical analysis trader. A simple search, like any search online, would flood you with information about technical analysis, leading you to different indicators, different processes, different methods. What would be a great first step for somebody who's starting out at trading to kind of learn about technical analysis in a way that's not going to distort their vision and not going to kind of corrupt their raw trading mind?
Well, I think it's important to recognize that technical analysis is very broad. There are many different methods. There's no right or wrong method. And a lot of it depends on what suits you, suits your personality. Some people prefer price action. Some prefer very indicator heavy based, sentiment based. So it totally depends on what suits you. So I would encourage anybody looking to learn technical analysis to read some books, to do some research, to sort of see what's out there. And once you've decided what you believe or what you want to try that resonates with you, to give it a proper go. A lot of people will start with something, then stop it after 2 months and try something else and keep hopping from indicator to indicator or system to system and never really give it an opportunity to work. What's more important than the system or the technical analysis that you use is that you've got your mental side of trading in place. Okay, so it doesn't matter what system you use. If your risk management or your trading psychology is not up to scratch, you're not going to make money in these markets. You might have a short period of time, over a long period of time, you're going to get caught out. So I'd spend more time starting there to make sure you start learning trading at the right manner. And after that, you can go through the systems and see what works for you. I make no secret, I'm well adversed and I've learned multiple different methods of technical analysis. And for me, I apply Elliott waves as my primary, because for me, that totally works for me. It suits my personality, and I've managed to utilize it for many years now. So,
very nice. And a quick aside part to that question. With Elliott Wave, what are a couple of indicators that you're kind of a go-to indicator that you'll use when you're charting out?
So indicators, most of them are actually lagging, okay, which is important to know, which is why pure indicator-based systems often don't work out in all conditions. So I use the indicators as a secondary indicator or a secondary form of analysis.
Yeah.
I would never make a trading decision purely based on indicator. So the two that I use is the MACDs, and I've actually given a lecture, or I've done a webinar on how to tie that in with Elliott waves, how it ties into the waves, one on the divergence side, the other on where you normally see the highest technical show with regards to the different wave degrees, when you sort of in wave threes, when the market's the sort of text embed to the upside or embed to the downside. So yes, I incorporate that with my Elliott waves analysis, and I use it as a secondary tool. I also use RSIs, again, very much as a secondary indicator, also for divergences and also to see sort of overbought, oversold. And again, with regards to wave degrees, I know where I expect it to embed on the overbought side, and I know when a market is sort of a corrective move and when it's overbought or oversold. So yeah, those are the two that I use, but there are plenty one could use. The OBV is very useful. The Bressets are very useful. But again, you just can't use all of it. For me, it's very much secondary, and those are the two that I use.
Very nice. Yeah, it's almost a way to confirm your decision.
Correct.
rather than the primary decision-making factor.
Exactly that. And you often see that I'll make a note, or the texts are confirming this move, or the texts are warning me of an impending breakdown. So yes, I use that as a warning, but I'm not going to go and change my whole thesis or position, but it gives me an extra dimension.
Yeah, of course. It's like a second opinion.
Yeah, good way to look at it.
So speaking about mentor rooms, I going around the internet, and it seems like a lot of people are trying to take trading seriously. They're trying to turn this into a business and trying to really progress as if this was their career in a way. And with a lot of career building, there seems to be expenses. With mentor rooms in particular, I was curious to pick your brain about whether or not you consider a mentor room as part of a natural expense of becoming a trader. And as a second part to this question, whether or not a trader can reach a level where they don't need a mentor room again, or what would that look like for somebody to kind of surpass the need for a mentorship program?
So take it to the first question. Having a mentor or having a trading group, however you want to do it, will probably save you a lot of money in the long run. Yeah. And what you normally find is, how do people find mentor rooms or find groups? Is they try trade by themselves, they blow up account after account, until eventually they decide they're going to learn how to trade the correct way. Yeah. So the cost of blowing up those accounts are probably more than a mentor room would cost.
Big time.
But then also, once you finish doing that and you sort of join the mentor room, you've learned all the wrong things, you've learned all bad habits, and you have to then actually end up unlearning what you've learned. And I've seen this from my room, that traders who come fresh without any knowledge, just new to trading, tend to pick it up really, really quickly and tend to do really, really well. And that's purely because they've learned to trade the correct way. I'm not saying my way is the only way to trade. There are many ways to trade, but they've learned to trade correctly. They've started trading with the right risk management tools, with the right trading psychology in place. And yeah, for me, it will save you a lot of money in the long run if you actually start to, if you learn to trade the correct way when you start out. As for when someone doesn't need a mentor or doesn't need a group, that's very dependent on the person. Yeah. I stayed in a room. I was part of a group when I was learning for 6-7 years. And I stayed because I still liked the analysis. I still enjoyed my time in the room. I have a member who actually wrote me a testimonial yesterday who said, "Thank you for everything. You've really taught me to trade the right way." Very appreciative.
Yeah, I saw that on YouTube.
Right.
That's nice.
And he's decided to leave. That was his farewell message, because he feels that he can do it on his own now, and he feels that he's ready to branch off. And that's totally fine. It just depends on when you feel comfortable. I'm sure if he goes through a bad patch, or if things, he might find it lonely, I don't know, he'll probably come back in the future. So you do see that. You see people come, people go, and there's nothing wrong with attempting to do it by yourself and coming back when you feel you're ready. So it just depends on the person. Some will stay all the time because they like the analysis as well, or the group camaraderie, the group, because you learn. In trading, there's no right or wrong way. So sometimes I might see a market one way, and my members will say, "Well, Greg, what about this?" And I'll look at it and I'll go, okay, it's something that I missed. You're not going to always catch everything. So just having that sort of group, or the people to analyze your work, or, I'm talking more for members and myself, but even for myself, sometimes I miss things, and a member will say, "What about this?" And I'll pick it up. Often we'll see in the room members discussing charts to each other, and I'll go through all the different potentials or possibilities. So I think it's very important, personally. And I think you're more likely to be successful in the long run if you learn to trade correctly from the outset.
Nice. Now, to pivot to a bit more of a topical question, so crypto related, I drive to work and I see on billboards marketing geared straight towards meme coins and random crypto jargon. Have you ever seen a market so geared towards novice traders and new traders? And is this what we've been talking about, the mania stage, really, where it's hyping up, and even the marketing is kind of caught straight back up to where we're all at?
I think that's half the problem, is the hyping of the meme coins.
Yeah.
I was in the pub, must be about 3 weeks ago now, and I was talking to my mate. We were having a quick crypto chat. and a
It's
drunk.
never a quick crypto chat.
No, it was a quick crypto chat.
Okay,
We're just
yeah.
catching up, and
one.
a drunk Irishman overheard our conversation and thought it would be a good idea to tell us about cryptos and what he's doing.
Yeah.
You know, he was talking about SHIB, Dogecoin, this other coin. I think it was SL something. It was some hospitality coin, another meme coin.
Yeah.
Flocky. And
That was the one that I saw the billboard for.
Right.
Floki coin or something. Like, what is this?
exactly that.
Random.
I mean, I didn't disclose I was a professional trader, and I was just interested in just hearing him out.
Nice.
And it's just crazy that because that's the coins that they hear or see, or more so, they read in the newspaper or online, investor made $5 million buying shitcoin, and investor made $2 million buying Dogecoin. So once it's already moved, already hyped and pumped, they then buy it because that's where they get to the stage where they know about it because they want to get rich from it. So yeah, I think that is a problem in the sense that, I mean, how many messages I get from people saying, can I look at this coin? And it's a meme coin. So yeah, you're better off sticking to the better chart, or if you are playing the meme coin game, understand the risks and know that there's nothing wrong with taking profits along the way, because unfortunately, much to many people's disappointment, Dogecoin is not going to $20 and shitcoin is not going to $4.
No, probably not. So that's the Staples Center, the Lakers home stadium, was just rebranded Crypto.com Stadium or whatever. So those are signs of the times, really. Things are really catching up. Okay, that was nice. Thanks for another weekly update, Greg. We're kind of asking questions. I guess this is a running segment, but we want to encourage anybody that has questions or anything really that you guys want Greg to cover off. We're an open book and we're ready to talk, and hopefully at some point we'll have more people in this room asking questions towards Greg, and we'll have a real juicy conversation going. But that's another one. We'll see you guys next week.
Thanks, Lucky. I enjoyed that.
Nice.